Welcome back to Global Business Report. Still on the outcome of the CBN's monetary policy meeting, I'm joined by Robert Omotunde, Vice President, Investment Research, to discuss the effect of an increase in cash reserve ratio, or CRR, on Nigerian equities and fixed income market as well. Robert, it's good to have you.
Thank you very much, Neve.
All right. So this is the third trading day after the MPC decision to increase CRR to 27.5%. Were you expecting this move, or would you consider it shocking?
Well, it was quite surprising that there will be a touch on the CRR, particularly. I mean, the expectation was that, if there was going to be any tweak in policy parameters, it would be on the MPR, given that market yields were, lower, significantly lower than the level of the MPR. But the MPC, in its wisdom, decided to tweak the CRR. I would say it was shocking, given that there are other policies of the central bank that came up before that meeting. I could say since the mid of 2019, we've seen some policies, being rolled out by the central bank. But again, that may perhaps speaks to the independence of the Monetary Policy Committee, so to speak, in the sense that, the central bank is supposed to be, is the apex bank for the country. Then the Monetary Policy Committee is saddled with the responsibility of monetary policy management. So, and oftentimes Monetary Policy Committee will meet and make, suggestions, on what policies they think need to be implemented for monetary policy actions. Sometimes the central bank, the actions of the central bank, which is the bank itself, sometimes may go against what the Monetary Policy Committee is saying, which I would say that the need to increase CRR, which was announced by the committee on Friday, somewhat negates some of the LDR policies which the Central Bank of Nigeria rolled out since, I would say, September ending 2019, which also went up to 65% by December of 2019. Well, so it was shocking.
It is shocking, but the CBN still has the final say on this, despite the contradictions from the...
Well, so the way it is monetary policy meets every 2 months. They meet every 2 months, or at every point in time. But when they make policy decisions, between the time the committee is not sitting, the central bank has the mandate. Don't forget that the central bank still has the mandate for monetary policy management. So to some extent, indeed, the central bank governor is the chairman of the committee, so to speak. So the central bank will still have a say. Sometime the committee may say we are going the way. March, central bank can still come up, with some form of regulation that might still, either further increase or reduce the impact of this policy. For example, if you look at before this policy was made, CRR was at 22.5%. But indeed, effective CRR, month in, month out, depending on the month you're looking at. In fact, as September, it was around 25.8%. That's what effective CRR, was. So taking a CRR to 27.5% now, it's just going to have about maybe another 2.5% impact on the overall liquidity in the system, because already, as against what the CRR, the CRR level that the MPC advised, which is 22.5, central bank has always maintained, CRR, effective CRR at around 25%, on the average. So that's a clear case of the situation where the MPC makes a decision and the central bank still has a final say, so to speak, in your own words.
Well, in light of what's happening at the moment. All right, interesting perspective, Robert. Now, talking about the implications of this decision, especially in light of the recent LDR policy of the CBN and, of course, the build-up in domestic inflationary pressure. So what do you make of that scenario?
Well, I think one of the reasons that the committee adduced for its decision was that there's a need to curb inflationary pressure. But again, somewhat disagree with the position of the committee in the sense that the current inflationary pressure we're experiencing is not a demand side inflation, so to speak. So in economics, there's a demand pull inflation and the cost push inflation. So historically, when you study Nigeria's inflationary trend, it will suggest to you that it's always been cost driven. And look at what happened. everybody knows that the border was shut since August. True. The impact of that border closure was, increases in domestic food prices, which had direct impact on the consumer price index, which is used to measure the rate of inflation. Yeah. So technically, we could see that the inflation level that is rising can be attributed to higher cost levels that we're seeing within the economy. Okay. Now, when you now say you want to, curb excess liquidity in the system, and reduce the so-called level of inflation, then you'll be wondering, increasing CRR naturally, what it does is that, if you look at LDR, for example, LDR was trying to encourage the banks to lend, which was why the central bank increased the loan-to-deposit ratio from 60% to 65% now. So that is minimum loan-to-deposit ratio the banks are expected to maintain is at 65% levels. Now, in addition to that, you're now coming up with a policy to further quarantine part of the funds which the banks can lend, because essentially what they have done now is, if the banks have maintained 65% loan-to-deposit ratio as like December, by now, if deposits don't grow, their capacity to lend more is now reduced, because CRR is now effectively at 27.5%, based on the new rule. So the impact of this is naturally or theoretically, what it should do is to reduce the amount of money in circulation, so to speak, because the ability of the banks to create more money through lending will be constrained, And the effect which the the MPC is trying to relate to is to say that let's curb inflationary pressure by increasing this level of CRR. And I say that it's not that connected, because inflation level right now is more cost-driven than demand pull. Maybe that is why it's a little bit shocking that, central bank is coming up with a policy and the MPC, is again, it's like they're going at cross purposes.
Cross purposes, I just remember that old saying by Albert Einstein, for every action, there's an equal and opposite reaction. It seems to come into play here. So how do you expect the fixed income market to respond to this new CRR policy in light of system liquidity expectations in the near term?
Yeah, so what we know is that you will recall that we've said it in this studio before that, the number of liquidity that are expected to come into the system for the first quarter of 2020. Now, you note that since last year, when that dichotomy was created in the fixed income market, we are beginning to see that treasury rates, especially for treasury bills and bonds, are beginning to fall lower and lower. Okay. Now, the immediate reaction to this kind of policy will be that there will be additional liquidity that will be taken out of the system. Okay. When you look at Friday, for example, system liquidity was around 600 billion. There was a debit for some bond auction, was conducted last week. This morning, liquidity level system liquidity was around 300 billion. Now, the impact of this increased CRR, remember I said before that effective CRR was around 25.8 before this policy was introduced. Now, if the central bank is to debit the banks for the excess to make CRR 27.5, the estimate is around 299 billion, that the central bank needs to debit. So that will create immediate impact on the fixed income market in terms of liquidity. So the system will be scarce of liquidity. When liquidity is scarce in the system, what you expect is that there may be a slight uptick in rates. But I don't think that this will be sustained, given the quantum of liquidity that we're expecting, especially in February. There are almost maturity of over 2 trillion that we're expecting in February, out of which we expect that close to 1.2 or 3 trillion of it can still access the treasury bills and bonds market. The implication of this is that we'll still expect that yields will fall lower going into February.
And in view of what you just said, briefly, should investors be worried, wary of that?
Well, there are investors that have been worried since this policy was introduced. The PFAs, who are the largest fund managers, they have been enjoying very good rates, especially in the treasury bills end of the market. But right now, they are seeing a situation where yields are getting lower and lower. Of course, they will be worried. But if you are active in the fixed income market, this is an opportunity to also make some fantastic returns. You know, I mean, since the policy was introduced, some have been smiling to the banks because they've taken long positions. You know, when yields were, you know, significantly at mid double digits, around 14-15%. You know, right now the yields are crashing. Most of the people are smiling to the bank. But for new investments, you know, there are concerns. You know, but if investors are active, you know, there are opportunities to be made in the markets.
Indeed, Robert. Now, still on the current narrative, this is additional zero interest fund quarantined from the banking system here. How do you see the new CRR impacting on the financial performance of banks, especially the first quarter of this year?
Yeah, I mean, the banks are very resilient. Nigerian banks are to be specific. And you will see that most of the time when new policies come up, that will affect them in certain ways. The banks always find a way to, absorb it. What we are likely to see is that with this new, remember that the banks are taking deposit at a cost, whether it's savings or time deposit, it comes at a cost. Now, CRR takes that cost, takes the deposit away from them at zero interest, meaning the banks are paying interest on the deposit they get from customers, but the central bank pays them nothing for the CRR. So the net interest margin there is expected to be negative. That is, if the banks are not very ingenious in generating higher returns from other funds that have not been quarantined. So what we expect to see is a slowdown. You know, we will see some lower margin, especially from the net interest margin angle of the banks, but we think that the banks are very resilient. They know how to navigate the terrain, and they'll come out of it.
This is where innovation comes in, no doubt, Robert.
Absolutely.
Now, let's take a look at it. The equities market is still somewhat enjoying some positive elements, or rather sentiments, given that YTD return closed last week at 10.4% or thereabouts. So what are the likely impact of this new policy, CRR, on the short-term outlook for the equities market? Briefly, please.
Yeah, I mean, so far in the year, we've seen the equities market has been up. As of Friday, it was 10.4% year-to-date return. Before we got into the studio, it's been up, I think, about 0.3 basis point. 0.3%. So we expect that to some extent, the rally may, continue, especially given the alternatives that are limited in the fixed income space. But we don't expect it to be a long rally, so to speak, because there are so many other macroeconomic headwinds that we expect will impact on the performance of the domestic equities market.
Definitely, we'll be keeping an eye on proceedings, as it were. Robert, I'd like to thank you very much. Omotunde, Vice President, Investment Research. Always a pleasure to have you.
Thank you for having me.